Friday, December 5th, 2025. While everyone on social media is distracted by the green candles on the Bitcoin chart and the psychological resistance at the $140,000 mark, a far more significant shift just occurred in the plumbing of the global financial system at exactly 8:30 this morning, Eastern Standard Time. I have been tracking a specific series of filings from the Office of the Comptroller of the Currency and the Treasury Department for the last 18 months. And what just happened is not a drill, nor is it another rumor about a ban. It is the final click of the lock in a mechanism that has been under construction since 2023. Today marks the quiet enforcement deadline for the new Digital Asset Custody Framework, or DACF, a piece of legislation that was buried inside the omnibus spending bill passed 9 months ago. And if you are holding your assets on a centralized exchange or even in a self-custody wallet that interacts with major stablecoins, the rules of engagement just changed underneath your feet without a single press conference being held to explain it. Before we open the ledger and show you exactly where the liquidity is now legally trapped, you need to walk through 3 specific doors with me to understand the magnitude of this shift, and I am warning you, do not open door number 3 until we have laid out the evidence, because it changes how you view every transaction you have made in the last 4 years. Door number 1 asks the uncomfortable question. Who actually holds the private keys when the banking layer merges with the blockchain layer? Door number 2 asks, what is the real trigger for the sudden drop in decentralized exchange volume we saw overnight? Because I promise you it is not a lack of interest. And door number 3 hides the most dangerous metric in this entire ecosystem, a number called the non-compliant wallet velocity, which has been screaming a warning signal for 6 weeks and just hit 0 for a specific set of addresses. Remember door 2, because the timing of the decentralized volume drop is the smoking gun. Most retail investors think regulation is something that happens in courtrooms. With this gentrification of block space is the precise mechanism that forces the small players out without ever technically banning them. It is a soft eviction, executed purely through economics. When the transaction fee to move $50 of Bitcoin becomes $30 because JP Morgan and BlackRock are bidding up the block space for their settlement layers, the network is no longer yours. It belongs to them. And this is where the skeptic corner usually chimes in. I can hear the objection already. But Layer 2 solutions solve this. The Lightning Network, Arbitrum, Optimism, that is where retail goes. That is the standard retort. And on the surface, it sounds logical. But that objection becomes a clue when you look at who owns the sequencers for these Layer 2 networks. A sequencer is the traffic controller that decides the order of transactions before they are batched to the main chain. In almost every major Layer 2, the sequencer is centralized. It is a single server run by the development team or a foundation, which is a legal entity subject to the same subpoenas we just talked about. And just this week, a leading Layer 2 protocol quietly updated its documentation to include a compliance filter at the sequencer level. This means they can censor your transaction for 5 cents just as easily as the main chain can censor it for $50. The escape hatch is bolted shut. The cheap transactions are only cheap because they are processed on a centralized server that can be regulated. If you want true censorship-resistant DEC now, let's zoom out to the macroeconomic picture, because this regulatory crackdown didn't happen in a vacuum. It is the direct response to the sovereign debt crisis brewing in the G7 nations. The United States is running a fiscal deficit of 7% of GDP while not in a recession. That is unprecedented. To fund this, the Treasury needs to sell trillions in bonds. Who buys them? If the private sector prefers to hold deflationary crypto assets instead of inflating government fiat, the bond market collapses. So, the government has 2 choices. Make their bonds more attractive, which means raising rates and crashing the economy, or make the alternatives illegal or unusable. They chose option 2. Operation Choke Point 2.0 is simply capital controls, rebranded for the digital age. They are erecting a digital Berlin Wall to keep the capital inside the dollar system. And just like in the Cold War, the most valuable commodity is a tunnel. This is why I am watching the atomic swap protocols, technology that allows you to trade Bitcoin for Monero or other chains without a centralized intermediary. The volume on these protocols is the real fear gauge. When atomic swap volume spikes, it means smart money is exiting the surveillance grid. And guess what? It spiked 200% yesterday. That is your signal. The smart money isn't buying the ETF, they are buying the tunnel. But here is a forward pull that flips the script. While the West is building walls, the East is building bridges, but only for themselves.
The BRICS alliance, Brazil, Russia, India, China, South Africa, and their new members, announced the mBridge project expansion this morning. This is a central bank digital currency platform that allows them to settle oil and trade without touching the US dollar. And here is the kicker. The underlying technology is a fork of Ethereum. They are using our tech against the dollar. This is the geopolitical irony of the century. The US bans the tech to save the dollar, while its rivals use the tech to kill the dollar. This bifurcation means that in 2026, we might see a petro-Bitcoin or a gold-backed token issued by a sovereign state that is completely outside US jurisdiction but fully liquid globally. If that happens, the US regulatory wall becomes a prison, not a fortress. You will be locked inside a depreciating currency while the rest of the world trades on a hard asset-backed digital ledger. This is the Door 1 answer revisited. Who benefits? The emerging markets that adopt the tech without the baggage of the US banking system. They are leapfrogging us. Now, I want to plant another seed here, a rewatch trigger for later. Notice how I haven't mentioned consumer protection once in this entire breakdown? That is because if you read the 300-page text of the new custody rule, the phrase consumer protection appears 12 times. The phrase systemic risk appears 140 times. This isn't about protecting you from scams, it is about protecting the banks from you. They are terrified of a bank run where the money flows into a self-custodial wallet and never comes back. That is the nightmare scenario for a fractional reserve bank. Every dollar you hold in cold storage is a dollar they cannot leverage 10 to 1. You are deleveraging their balance sheet, and they hate you for it. Let's look at the evidence card of the stablecoin yields. Right now, you can get 5% on a treasury bill.
But on some quote-unquote compliant DeFi protocols, the yield is trading at 4%. Why would anyone take more risk for less yield? It defies basic financial logic. Unless the market is pricing in the confiscation risk of the treasury bill itself. If you are a foreign entity, maybe you trust a smart contract more than you trust the US government's sanctions policy. We are seeing a political risk discount being applied to US assets. The risk-free rate is no longer risk-free if your assets can be frozen by an executive order. This inversion, where DeFi yields are lower than treasuries, is a historic anomaly. It suggests a desperate demand for neutral yield, even if it pays less. People are paying a premium for neutrality. Now, I need you to focus because we are approaching the master key concept. But first, a specific actionable insight. Comment below with audit or blind trust. Do you check the smart contract code yourself, or do you trust the audit stamp? Because here's the dirty secret. 3 of the major auditors just got acquired by traditional accounting firms. The Big 4 are now auditing the code, and their standards are different. They are auditing for compliance, not just security. A contract might be secure from hackers, but vulnerable to a regulatory backdoor that the auditor mandated be inserted. We are seeing admin keys being left in protocols that claim to be decentralized. An admin key is a God mode switch. If the dev team has it, the regulator has it. Always check if the protocol has a time lock or a multi-sig on the admin key. If it is a single key held by an anon dev, that protocol is a trap.
If it is a multi-sig held by public, doxed entities in different jurisdictions, it is safer, but not perfectly safe anymore. Let's address the door 2 payoff more deeply. The trigger for the volatility.
We said it was the expiration of interest rate hedges in the private credit market in the first video, but in crypto, the trigger is the quote-unquote unlock schedule of the venture capital tokens. Today, December 5th, marks the cliff unlock for a major quote-unquote layer 1 competitor to Ethereum. $200 million worth of tokens just unlocked for the early investors who bought in at 5 cents. The current price is $3. Do the math. They are up 6,000%. They are not hodling, they are dumping. And because of the low liquidity we discussed earlier, their selling is crashing the price harder than usual. The retail investors are buying the dip, thinking it is a market correction, while the VCs are using them as exit liquidity to move into, you guessed it, compliant real-world assets. The VCs are rotating from the casino to the bank. They know the party is over. They are cashing out their chips and buying the building. This is the, quote, great rotation of 2025. From speculative tokens to tokenized equity and debt. The era of the 100x gem is ending. The era of the tokenized treasury bill is beginning. It is boring, it is regulated, and it is where the trillions are going. And here is the subscribe bait that I promised. Next week, I am doing a deep dive into the blacklist of wallets. I have found a tool that lets you scan your own address to see if you are 3 hops away from a sanctioned entity. You might be tainted and not even know it because you traded with a guy who traded with a guy who used a mixer. If you want to see that tool and learn how to clean your wallet hygiene, hit subscribe and turn on the bell. You cannot afford to be dirty in a sterile system. Now, let's open door 3 fully. The non-compliant wallet velocity hitting 0 for specific addresses. This wasn't just random users. These were the addresses associated with the market makers themselves, the entities that provide the liquidity to the market. When the market makers stop using non-compliant rails, the market structure breaks. We are seeing ghost order books. You look at the screen and it shows a buy wall, but when you try to sell into it, the order vanishes. It is spoofing on a massive scale because the real liquidity has left the building. The bots are just painting the tape to keep the retail hopeful. This is the most dangerous environment to trade in. You are playing poker against a ghost who can see your cards and pull his chips off the table the second you bet. The advice? Stop trading short-term timeframes. The noise is manipulated. The signal is only visible on the weekly and monthly charts. But there is a twist in the narrative, a skeptic corner rebuttal that actually supports our case. Some say, crypto is global, the US can't kill it. Correct. The US can't kill the code. But they can kill the on-ramp and the off-ramp. And without the ramps, the ecosystem becomes a closed loop, a circular economy. And that might actually be the bullish case long-term. If we are forced to stay in crypto, we start spending crypto. We start pricing labor in crypto. We stop caring about the dollar price because we never go back to dollars. This crackdown might be the catalyst that finally forces the separation of money and state. By locking the doors, they are forcing us to build a new house inside the burning one. It is the accidental revolution. They wanted to control it, but they might have just made it independent by necessity. If you can't cash out, you spend. If you spend, you create a real economy. This is the Bitcoin circular economy thesis, and today's regulations just accelerated it by 5 years. Pain we are feeling now is the birth pangs of a parallel system that no longer needs permission to exist because it no longer seeks permission to exit. So, where does this leave you today, right now? You are standing on a shifting tectonic plate. The old crypto of wild speculation and anonymous transfers is sliding into the ocean. The new crypto of regulated, surveillance-heavy, institutional-grade assets is rising from the sea. You can try to cling to the old island, but it is shrinking. Or you can migrate to the new continent, but you have to pay the tax and show your ID. Or you can find the life rafts, the privacy technologies, the decentralized computing networks, the sovereign hardware that allow you to float between the two worlds.
That is the hardest path, but the most rewarding. It requires technical competence, constant vigilance, and a refusal to take the easy path of convenience. Convenience is the bait, control is the hook. I want to give you one specific plant for the future. Watch the hash rate distribution of Bitcoin over the next 3 months. There is a rumor, unconfirmed but persistent in the data centers, that a major sovereign wealth fund in the Middle East is acquiring mining hardware at a pace that dwarfs BlackRock. If a nation-state captures 5% of the hash rate, the game theory changes again. It becomes a strategic energy asset, not just a financial one. Keep your eyes on the mining difficulty adjustments. If it jumps unexpectedly without a price increase, you know the giants have entered the chat. As we move toward the final conclusion, remember the liquidity notice from the start. The entity that filed it? It was a crypto-native prime broker, the bridge between the hedge funds and the exchanges. When the prime broker freezes, the hedge funds freeze. When the hedge funds freeze, the selling pressure stops, but so does the buying. We enter a zombie market. Prices drift aimlessly on low volume. This is the accumulation zone for the patient and the kill zone for the impatient. The master key to survive this is time horizon arbitrage. The institutions operate on quarterly cycles. They panic when the quarter looks bad. You operate on a decade cycle.
You buy their panic, you hold through their consolidation, you sell into their mania. The regulation is just noise designed to shake you out of your position before the asset is repriced for the new world order. They want your Bitcoin cheap. They want you scared of the ban, so you sell it to them. Don't give it to them. The echo of the planted clue. Remember the vintage of the coins? I said pre-regulation coins trade at a premium. That premium is already appearing in the OTC markets. A virgin Bitcoin, freshly mined and never transacted, is selling for 5% above spot price. Why? Because it has no history to trace. It is the only truly blank slate money left. If you are a miner, you are minting gold. If you are buying on an exchange, you are buying melted down jewelry that might have been stolen. The market knows the difference. Finally, let's answer the door 3 question fully. The hidden metric was non-compliant wallet velocity. It hit 0 for the market makers, but it just spiked for a different group, the developers. The people building the protocols are moving their funds to privacy-preserving addresses. They are going dark. When the builders go dark, it means they are preparing for a war of code versus law. And in the history of the internet, code usually wins, but the transition period is messy. You are living in the mess. Embrace it. We are about to close this investigation, but there is one last piece of the puzzle that fits into the master key. The real trigger for the next bull run won't be an ETF approval or a rate cut. It will be the failure of a major fiat currency that drives a G7 population to adopt crypto out of desperation, regardless of the laws. Look at the bond yields in Japan or the UK. The cracks are there. When the dam breaks, the regulatory wall will be washed away by a tsunami of panic capital. Laws only work when people fear the punishment more than the alternative. When the alternative is hyperinflation or confiscation, the laws become irrelevant. We are not there yet, but the trajectory is clear. The compliance phase is just the accumulation phase for the state. Once they have accumulated enough, they might flip the switch again. But for now, play by their rules, but keep your exit strategy in your own hands. This brings us to the final moments of this briefing. You have seen the 3 doors. You know who benefits, the custodians. You know the trigger, the liquidity freeze. And you know the hidden metric, the wallet velocity. You have the map. The question is, do you have the discipline to follow it? Most people will ignore this. They will look at the price and say, everything is fine. They are the exit liquidity. You are the informed. Stay informed. And before I give you the final line, hit the comment section with your prediction for the sovereign miner. Which country mines Bitcoin publicly first? Saudi Arabia? UAE?
or a dark horse like Argentina? I want to see your geopolitical radar. Here is the recap. The crypto regulation isn't coming. It is already live. It is a system of allow lists and block censorship that turns public blockchains into private banking networks. The master key is recognizing that the value is bifurcating into compliant, low reward, and sovereign, high risk, high reward assets. You need to balance your exposure between the two. Do not go 100% into either. Use the white market for stability and the gray market for optionality. This is not financial advice, it's education and pattern recognition. The map is not the territory, but it's the only guide you have in a world where the landmarks are being erased. Once you see the map, you can't unsee it. Stay liquid, stay skeptical, and never lose your private keys.
I will see you in the next investigation. Actually, we are not done yet, because there is an addendum to this investigation that was just leaked from the OECD meeting in Paris. And if you thought the US regulatory clampdown was the end of the story, you are missing the global pincer movement that is about to close around your portfolio. While the American regulators are building the walls, the international tax authorities are building the surveillance drones that fly over them. I am talking about the Crypto Asset Reporting Framework, or CARF, which is effectively the FATCA for the blockchain age. This framework was quietly ratified by 48 nations, including jurisdictions that many crypto influencers told you were safe havens. Places like Switzerland, Singapore, and the Cayman Islands have signed on. What does this mean? It means the era of geographic arbitrage is ending. In the past, you could move your crypto to a friendly jurisdiction to avoid the watchful eye of your home country. Under CARF, every exchange, every broker, and eventually every major decentralized finance front end in these 48 countries is legally obligated to automatically share your transaction data with your home country's tax authority. It is an automatic information exchange network that covers 70% of the global crypto volume. This system goes live on January 1st, 2026. That is less than 30 days away from our current narrative timeline. If you have assets sitting in a foreign exchange thinking they are invisible to the IRS or HMRC, you have exactly 4 weeks to restructure before your entire transaction history is beamed directly to a server in Washington or London. This brings us to a new evidence card, the tax gap projection. Governments are estimating they are missing out on billions in revenue from undeclared crypto gains. They are not looking to ban crypto anymore. They are looking to milk it.
They need the tax revenue to service their sovereign debt. Now, let's look at the door one question from a different angle. Who benefits if the gray market is taxed out of existence? The answer is the tokenized real-world asset issuers. These are the companies putting real estate, gold, and private credit on the blockchain. They cannot exist in a gray market. They need absolute legal clarity to enforce ownership rights in court. If you own a token representing a slice of a building in Manhattan, you need a judge to recognize that token. That is why the industry is pushing for these harsh regulations. They are sacrificing the cypherpunks to pave the road for the landlords. We are witnessing the gentrification of the technology stack. The permissionless nature of the blockchain is being replaced by permissioned access to off-chain rights. This is a fundamental shift in value proposition. Bitcoin was valuable because it was money without a master. Tokenized assets are assets with a digital receipt. They are not the same thing, and the market is currently confused, pricing them as if they are part of the same revolution. They are not. One is a revolution. The other is a digitization of the status quo. I want you to drop a comment. Revolution or digitization? Which side of history is your portfolio betting on? Because you cannot bet on both with the same asset. Here is a forward pull regarding the AI audit capability. The IRS just announced a contract with a major data analytics firm to deploy AI agents on the blockchain. These aren't human auditors. These are algorithms that scan billions of transactions to find patterns that look like tax evasion. They look for circular trading, wash trading, and structuring, breaking large transactions into small ones.
The human eye misses these. The AI sees them instantly.
If you move $10,000 in 10 transactions of $1,000 each to avoid a reporting threshold, the AI flags that as structuring, which is a felony. The skeptic corner argument used to be, there are too many transactions, they can't catch us all. That was true when humans were doing the work. It is false now that AI is doing the work. The catch rate is about to go exponential. This is the hidden metric of enforcement efficiency. It has gone from 1% to virtually 100% for on-chain activity. The only place the AI cannot see is inside the zero-knowledge privacy pools we discussed earlier, which is why the regulators are targeting the developers of those pools. They want to turn off the lights so the AI can see everything. Let's pivot to the Trojan horse of interoperability. The SWIFT network, the backbone of global banking, is testing a new connector that links central bank digital currencies, CBDCs, with existing banking rails. This sounds technical, but the implication is social. They are going to offer you seamless transfers. You will be able to send dollars to a friend in Europe who receives euros instantly using a blockchain backend. It will be cheap, fast, and convenient. And it will require a digital ID that links your bank account, your social security number, and your biometric data. Convenience is the trap. Most people will accept the digital ID to save $30 on a wire transfer fee. Once the majority adopts the ID, it becomes the standard. If you refuse the ID, you are locked out of the fast lane. You become a second-class digital citizen. This is how they manufacture consent. They don't force you. They just make the alternative inconvenient and expensive. We are moving toward a subscription model for financial freedom. You pay with your data to get access to the liquidity. Now, I promised a master key revelation about the timing.
Why is all of this hitting in December 2025?
Because of the Basel IV implementation timeline. The global banking standards are shifting to require banks to hold more capital against risky assets. By classifying compliant crypto as a Tier 1 asset and non-compliant crypto as a Tier 5 asset, which requires 1,250% capital backing, they have made it mathematically impossible for a bank to touch the gray market. It is a capital blockade. A bank would have to hold $12 of capital for every $1 of Bitcoin they hold, unless that Bitcoin is held in a compliant manner. This is the death blow to institutional adoption of permissionless crypto. The only crypto that banks will touch is the crypto that has been sanitized by a custodian. This is why the custody business is the hottest sector in VC right now. They are the sanitation department for the asset class. But there is a ghost in the machine, a signal that refuses to die. The hash rate of the Bitcoin network is hitting all-time highs despite the price volatility. This means the miners are not capitulating. They are investing billions in new hardware. Why? Because they know something the market doesn't. They know that energy is the ultimate currency. In a world where fiat currencies are debased and digital assets are surveyed, proof of work is the only thing that cannot be faked. It is thermodynamic truth. The miners are betting that eventually the world will need a neutral settlement layer that is backed by physics, not politics. The war on crypto is really a war on neutrality. The powers that be cannot tolerate a neutral money. They need money to be a weapon. But physics doesn't care about politics. If the network runs, the block is produced. This resilience is the ultimate bear case for the total control narrative.
They can build walls, but they cannot stop the heartbeat of the network.
Here is the subscribe bait for the deep endgame. I am compiling a list of the jurisdictions of last resort. These are the countries that are explicitly rejecting the OECD and US pressure. They are building their own free zones. If you want to know where you can legally exist outside the dragnet, you need to see this list. It is short, it is risky, but it is the only exit door left. Subscribe so you don't miss the Geography of Freedom report. Let's address the plant regarding the liquidity notice one final time. The notice mentioned a market value trigger. In the context of the tax crackdown, this trigger is the forced liquidation of tax delinquent accounts.
The IRS has the power to order an exchange to liquidate your assets to pay a tax bill. They don't need to seize the coins, they just order the sale. This turns the exchange into a deputized tax collector. If you keep your funds on a centralized exchange, you are giving the IRS a call option on your wealth. They can call it away whenever they determine you owe them. This is the final argument for self-custody. Not because not your keys, not your coins, but because your keys are the only legal defense against administrative seizure. Possession is 9/10 of the law, and in crypto, possession is cryptographic. If they don't have the key, they have to negotiate. If they have the exchange login, they just take it. The echo of the vintage concept returns here. The pre-KYC coins are becoming collector's items. There are OTC desks now that specialize in heritage Bitcoin, coins mined before 2012 that have never touched a KYC exchange. These coins trade at a 20% premium. Why? Because they are invisible to the historical data dragnet. They are the ghost ships of the blockchain. If you own any of these, do not mix them with your white market coins.
You will contaminate them and destroy their premium. Keep them separate. Treat them like rare art. We are closing in on the absolute final takeaway. The master key to navigating 2026 is compartmentalization. You must have a public identity portfolio that is fully compliant, pays its taxes, and interacts with the banking system. This is your operating capital, and you may choose to have a private sovereignty stack that never touches the banking system, never touches a centralized exchange, and is acquired through peer-to-peer labor or mining. This is your insurance policy. Do not cross the streams. The moment you send one Satoshi from your private stack to your public stack, you burn the bridge. The blockchain remembers everything forever. One mistake links your identities permanently. The discipline required to maintain this separation is immense, but it is the price of freedom in a digital panopticon. The final emotional hook. You entered crypto because you wanted to opt out of a broken system. The system has now surrounded crypto and is trying to digest it. But the core, the code, the cryptography, the idea is indigestible. It survives. You can survive too, but not by being naive. You have to be sharper, faster, and more paranoid than the institutions hunting you. The days of easy money are over. The days of hard money are just beginning, and hard money requires hard decisions. This is not financial advice. It is a survival manual for the digital age. It is education and pattern recognition. The investigation never truly ends, it just evolves. Stay liquid, stay skeptical, and keep your private keys offline. I will see you in the next investigation.